Meet Tyler. Tyler is 31. He just bought his first home. He's posting photos of the keys on Instagram. His mom cried. His dad shook his hand. His co-workers are congratulating him like he just ran a marathon. And Tyler feels like he has finally made it. Tyler also just signed up for 30 years of debt on an asset that, when you actually run the numbers, will probably underperform a basic index fund by a margin that should make him sit down quietly in a dark room for a few minutes. But Tyler doesn't know that yet. Because nobody told him. Because in America, homeownership isn't just a financial decision. It's a religion. And questioning it gets you the same look you'd get if you asked why we do the electric slide at every wedding. You just don't do it. So let's do it. Because the mythology of homeownership is one of the most deeply embedded, emotionally charged, financially expensive pieces of conventional wisdom that an entire generation has swallowed whole. And by the end of this video, I want you to actually look at the math, not the feelings, not the Instagram posts, the math. Let's start with the number Tyler's bank is very excited about. He bought a $4,000 home. He put 10% down, $4,000, and financed the remaining $36,000 at 6.8% interest over 30 years. That gives him a monthly mortgage payment of about $2,350. Sounds manageable, until you add up everything else. Property taxes on a $4,000 home average around 1.1% nationally. That's $4,400 per year, or $367 per month. Homeowners insurance runs another $150 to $200 per month. HOA fees, if Tyler's in a suburb, and Tyler is absolutely in a suburb, average $250 to $300 per month. And maintenance. Maintenance is the one everyone forgets to include. The general rule is 1% to 2% of the home's value per year. On a $4,000 home, that's $4,000 to $8,000 annually, or roughly $333 to $667 per month. Now add it up. Mortgage, $2,350. Taxes, $367. Insurance, $175. HOA, $275. Maintenance, $500. You're at $3,667 per month to own a $4,000 house, and that's before Tyler replaces the water heater, fixes the roof, or discovers what previous owners did to the plumbing. Now here's the part that genuinely makes people angry when they hear it for the first time. In the first year of Tyler's mortgage, of his $2,350 monthly payment, approximately $1,040 goes to interest, and $310 goes to principal, meaning $300 per month is actually building equity. The rest is just renting money from the bank at a price the bank set. That's not a conspiracy. That's just how amortization works. And the bank doesn't hide it. It's right there in the loan disclosure documents that approximately nobody reads. Over the full 30 years, Tyler will pay approximately $486,000 in interest alone, not including taxes, insurance, HOA, or maintenance, just interest. He bought a $4,000 house and will pay the bank $486,000 in interest before it's over. The total cost of ownership, when you stack everything together, is somewhere north of $9,000 to $1,000 for a house that today is worth $4,000. Now let's talk about what everyone says next. But Tyler, the house appreciates. Yes, it does. Historically, U.S. home prices have appreciated at about 3% to 4% per year nominally, which sounds great until you remember inflation runs about 2% to 3% per year. That means in real inflation-adjusted terms, housing has returned about 1% annually since 1900. Economist Robert Shiller, who literally won a Nobel Prize for studying asset prices, spent decades tracking this and concluded that real long-term home price appreciation is essentially flat, 1% real return, on an asset that requires 1% to 2% per year just to maintain it. You're running to stay still. Meanwhile, the S&P 500 has returned approximately 10% annually over the long term before inflation and around 7% after. If Tyler had taken his $4,000 down payment and his monthly $3,667 ownership costs and instead rented a comparable place for $2,200 a month, which in many markets is still cheaper than owning, and invested the $1,467 monthly difference into a basic index fund, the math over 30 years at a 7% real return is somewhere in the neighborhood of $1.7 million. That's not a guess. That's a compound interest calculator available for free on Google. And before you type your comment, yes, I know, Tyler gets to build equity. Tyler gets stability. Tyler gets to paint the walls whatever color he wants. Those things are real, but they're not financial arguments. They're lifestyle arguments. And conflating a lifestyle preference with a sound investment decision is exactly how the myth survives. Because here's where it gets really interesting. The renting is throwing money away line, which gets repeated like a financial mantra at every family barbecue, has a fundamental logical problem. You're also throwing money away when you pay interest. You're throwing money away when you pay property taxes. You're throwing money away when you pay insurance and HOA fees and maintenance costs. The only part of a mortgage payment that isn't throwing money away by that same logic is the sliver of principal you're building in equity. And in the first decade of a 30-year mortgage, that sliver is embarrassingly small. In year one, Tyler builds about $3,720 in equity from principal payments. He paid over $44,000 that year in total ownership costs. His equity growth from principal alone represents less than 8.5% of what he spent. The rest, by the throwing money away definition, went somewhere else. Now, here's where I have to be fair, because this isn't a binary answer, and anybody who tells you renting is always better or buying is always better is selling something. There are real, legitimate reasons to buy a home. If you plan to stay somewhere for 10 or more years, the math starts shifting. Over long enough time horizons, appreciation and equity accumulation can start to compete with investing alternatives, especially in high-growth markets. Owning eliminates rent inflation risk, meaning your housing cost is largely fixed while rent can go up 5% to 10% every year depending on the market. A paid-off mortgage at 65 is a massive lifestyle hedge that doesn't show up cleanly in spreadsheets. And leverage, the ability to control a $4,000 asset with $4,000 down, amplifies your gains during appreciating markets in a way you can't replicate with index funds. But the key word there is leverage. And leverage is a double-edged sword that personal finance TikTok doesn't spend a lot of time discussing, because leverage amplifies losses just as effectively as it amplifies gains. If Tyler's $4,000 house drops 15% in value, which happened broadly across the U.S. from 2007 to 2011, he's now sitting on $34,000 in value against a mortgage he still owes $305,000 on. He's underwater. He owns nothing. In fact, he owns negative equity. And unlike a stock that drops 15%, he can't just quietly hold it in a brokerage account. He has to keep paying $3,667 per month whether the asset is worth it or not. This is what makes the Great Financial Crisis so instructive and so easy to forget. In the mid-2000s, home prices had been rising so consistently that the idea of a nationwide housing price decline was treated as essentially impossible. Banks modeled for it and decided it wouldn't happen. Rating agencies agreed. Wall Street built trillion-dollar structures on that assumption. And between 2007 and 2012, U.S. home prices fell approximately 27% nationally. Millions of homeowners lost everything. The dream of homeownership became the mechanism of financial ruin for a generation that had been told it was the safest thing they could do with their money. And here's what nobody has fully reckoned with since then. The underlying psychology didn't change. The narrative didn't change. Buying is better than renting is still the default assumption in almost every personal finance conversation in the country. We had the biggest housing-driven financial catastrophe in a century and came out the other side with the exact same mythology intact. So what should you actually do with this? If you're buying primarily because you think it's a sound investment, run the actual numbers for your specific market. Use the New York Times Rent versus Buy calculator or any comparable tool. Input your actual home price, mortgage rate, expected tenure, and local rent alternatives. Let the math talk. In expensive coastal cities, renting and investing the difference frequently wins over 10 to 15-year horizons. In mid-sized inland markets, ownership can make sense much sooner. Time horizon matters more than almost anything else. If you're buying a house you'll stay in for fewer than 5 to 7 years, the transaction costs alone, closing costs, agent fees, and prepaid interest make it nearly impossible to come out ahead financially. A 6% real estate agent commission on a $4,000 home is $24,000. On exit. Just to sell. Stop counting your home's market value as personal wealth in the traditional sense. Yes, it's an asset on your balance sheet, but unless you're selling it and moving somewhere cheaper or taking out equity, It's a largely illiquid asset that you still have to live inside. It's not like a brokerage account you can tap cleanly. Don't confuse forced savings with smart investing. One of the real arguments for homeownership is behavioral. Mortgage payments force you to build equity in a way that investing in an index fund requires discipline to do voluntarily. That's a legitimate point, but if you have the discipline to invest the difference between owning and renting, the math typically favors investing. The question is whether you actually have that discipline. Most people don't, which is why the behavioral argument for homeownership is more powerful than it gets credit for. Here's the uncomfortable bottom line. Buying a home is not automatically the best financial decision you can make. For some people, in some markets, at some stages of life, it absolutely makes sense. But the blanket certainty with which American culture has decided that renting is for suckers and ownership is for winners has cost millions of people real money. It pushed people into markets they couldn't afford. It caused them to stretch into mortgages that left no room for error. And it convinced a generation to pour almost all their net worth into a single, illiquid, highly leveraged asset class and call it diversification. Tyler is going to be fine, probably, if he stays for 15 years, if rates come down and he refinances, if the roof holds, if the market doesn't crater, if he doesn't need that $4,000 for an emergency. That's a lot of ifs for something everyone called a no-brainer. So I want to hear where you land on this. Do you think homeownership is still the best long-term financial move for most Americans? Do you think renting and investing the difference is underrated and more people should seriously consider it? Or do you think this whole debate misses the point and housing is primarily a lifestyle decision that shouldn't be treated as an investment at all? Drop it in the comments because this is one of those conversations where everyone has an opinion and almost nobody has actually run the numbers.